As a more aggressive kind of dividend investor, I'm always on the lookout for high-yielding dividend stocks and ETFs that'll pay me the most in passive income while balancing the risks involved with holding these particular funds. I spend a lot of time on various websites like Yahoo Finance, Seeking Alpha, as well as some other stock and ETF screeners to try to locate the best dividend stocks out there. There's several reasons why I prefer to invest for income now as opposed to investing in traditional dividend growth stocks like Johnson & Johnson, even though I'm not retired. I simply find it a lot more satisfying to see all of these dividends being deposited into my brokerage account every single month and quarter, as opposed to simply holding onto a stock or an ETF for a long period of time and hoping that it grows. With this type of income investing, it really does feel a lot more like the companies that I own shares in are truly sharing the profits with me. If you struggle with the motivation to invest, I'd suggest you try a more income-seeking approach to investing. You might get really addicted to all of that money being paid out to you. With that being said, after going on this search to find the highest paying dividend funds a couple months ago, I found 4 funds in particular that I had never heard of and I had no idea how they worked. These 4 funds appeared to show ridiculously high dividend yields, ranging between 14.5% all the way up to over 30%. And I double checked to make sure that they're still paying dividends because I've seen stocks that show a really high dividend yield, but when I double check their dividend history, I can see that they recently slashed the dividend like a month ago. The 4 funds I'm referring to here are the Credit Suisse Covered Call Exchange Traded Notes, ticker symbols GLDI, REML, USOI, and SLVO. These 4 funds are unlike anything I'd ever come across before, and it took me a lot of digging to find these funds. When I discovered them, I really wanted to understand what exactly these funds are, and how are they able to pay such high dividends to investors. Because according to what I could find, the average dividend yield for a stock that's a member of the S&P 500 is roughly 1.9%, which isn't much. And as you can see, for REITs which offer higher dividend yields to investors simply because they have to, average about 5% for equity REITs and over 10% for mortgage REITs. Even another one of my favorite dividend investments, the Covered Call ETF, offers dividend yields of around 11% at most. So how are these funds able to deliver such sky-high dividend yields? First, we need to understand what an exchange-traded note is. According to Investopedia, an ETN is a type of unsecured debt security that tracks an underlying index of securities. They function pretty similarly to bonds, and their prices fluctuate since they trade on exchanges. If you look at the fact sheet for each of these 4 funds, it'll tell you a lot about how they function. First off, each of these 4 ETNs tell you what underlying index it uses. So for example, with the Gold Shares ETN, you can see that it tracks the Nasdaq Gold Flows 103 index, which is known as GLDI. Going further into this fact sheet, it gives us a really good explanation for those high dividends these funds pay. These funds seek to implement a covered call investment strategy by maintaining a notional long position in GLD shares while notionally selling call options on that position on a monthly basis that are approximately 3% out of the money. If you're familiar with ETFs that use covered calls, such as QYLD, these funds do have some similarities to that. And while pretty much any time these pooled investments use covered calls are going to generate a good amount of income, what you'll always sacrifice is higher long-term capital appreciation of the share price. This is because the options are sold every month and the option premiums are passed on to investors in the form of dividends. I know covered calls might be kind of a difficult thing to grasp if you're not too familiar with them, but there's lots of good videos on YouTube that go more in depth on how options work if you're interested in learning more. But I've personally noticed that these covered call investments have becoming much more popular, especially with funds with QYLD. Did you know that there's a subreddit for people who are obsessed with this fund? It's called QYLD Gang, and as of the making of this video, there's about 4,000 members who love to talk about this ETF in particular. So we know what these funds are, and we can see how they're able to pay such high dividends to shareholders, but probably the most important question we should be asking is, should we invest in these? And if so, how much should we invest in these funds? Exchange-traded notes are considered to be much riskier investments than exchange-traded funds. ETNs are issued by banks or other financial institutions, so if the issuing firm were to go under or simply go through a financially difficult time, the entire ETF could be called by the bank and you would lose your entire investment in it. In fact, this exact same thing happened back in March of 2020, with the UBS eTrax Monthly Pay 2X Leverage Mortgage REIT ETN, which was ticker symbol MORL. Once offering investors a 25% dividend yield, The notes were called by UBS, and every single penny investors had in it were wiped off. There's a whole Forbes article that I think is really worth reading if you're interested. It's called The Inside Story of an Investment That Plunged 98%, and it was written by Michael Foster. From what I've heard, a lot of brokerage platforms don't even allow investors to buy shares of ETNs because they're considered to be so risky. I can confirm that 2 platforms do allow you to invest in these ETNs, which are Fidelity and Vanguard. While I personally don't like Vanguard's platform, they did allow me to buy shares after giving me a page-long warning on why I shouldn't be buying these things. While I personally believe that every brokerage platform should freely allow their customers to invest in whatever they want and as much as they want, I understand why a lot of them wouldn't want investors to hold these kind of securities. If they tank like what happened with MORL, I could see how someone might want to sue them. But I don't think in that case the investor would have much of a chance of winning. But in terms of investing in these 4 funds in particular, from what I've gathered, they're probably the riskiest investments you could make in terms of dividend investing. The underlying indexes these ETNs track haven't been performing well over the long term. GLDI has dropped over 50% since its inception in 2013, and the other 3 funds have very similar results to that. This graph shows each of the 4 funds over their inception. SLVO and GLDI have continued to decline, whereas USOI and REML appear to have hit an all-time low back in May of 2020, but both have been slowly recovering since then. If you do decide to invest in these funds, you might want to consider reinvesting those dividends that you'll receive. Some of you may remember that a couple months ago I did announce that I did decide to pick up some shares of USOI just out of curiosity. I purchased shares when it was trading at $5.04 a share, and since then I have gotten positive gains on it a little bit, while also enjoying some high dividends along the way. According to the dividend reinvestment calculator on dividendchannel.com, if you'd invested $10,000 into USOI right after the plunge back in June of 2020, and if you chose to reinvest those dividends, your investment would have grown by almost 52% in just a year and a half. But obviously, we can't be certain that these kind of returns will occur going into the future. At this point, I don't really have any official plans to buy any more shares of these. I might do so in the future, but I've got my focus set on covered call ETFs right now, as well as some other funds I plan on discussing in the next couple weeks. But in summary, this is my opinion when it comes to investing in these funds. I probably wouldn't recommend making these funds more than, say, 5% or so of your portfolio, just because of how risky they are. I'm personally more comfortable with covered call ETFs than I am with ETNs. I do know that some of you have left comments on my videos saying that you've bought shares of one or more of these funds, and while you're obviously free to do that, I just really want to encourage people not to overinvest too much in these funds unless you have a really, really high amount of risk tolerance. I know that all of us want to live off dividends as soon as possible, and it makes sense for us to pursue higher yielding investments, but just be cautious not to overload on exceptionally risky funds, or else you could really set yourself back on attaining that goal if something goes wrong. Alright everyone, that's going to wrap up today's video. Thank you all so much for watching, I really do appreciate it. If this video benefited you in any sort of way, please click the like button below and click subscribe if you want to see more dividend investing strategy videos. It would just let me know that there's a sizable enough audience out there who wants this kind of content, and I'll continue to provide you all with that content. Alright everyone, thanks again for watching, and I'll catch you next time. Take care.